Robert in Texas says, we are probably close to the peak of the market. What argument exists to encourage continued new investment in the market at this time? So do you think we're at the top of the market? And why would you keep investing if that were the case?
I wish you could find someone who could tell you when you're exactly at the peak of a market and what's going to happen next. But I've been in this business 25 years, Bill, over 30 years. We've yet to find that person. Mm-hmm. So we can tell you that when markets are relatively cheaper or relatively more expensive, they're more on the expensive side now. That does not mean you're at a peak. Mm-hmm. It doesn't mean that there'll necessarily be a pullback. We could have a pullback. Even if, let's say we have a pullback in the first half of the year, Rebecca, mm-hmm. You shouldn't react to it. You should stick with your plan. And regardless of markets are going up or down, stick with your plan. If you try to react to them, you will lose. Mm-hmm. Now, you want a little encouragement to move on and keep going into equities. Equities they're there for your long-term growth. And if you look at the PE in the market right now, it's valuation at about 21 on trailing earnings on the S&P. It's really right where it was, say, in 1992. I'm my second year in this business. Mm-hmm. And the PEs were about this level. And there were people saying, well, get out of equities, they're too expensive.
Right. Well,
over the next decade, they went up. They went way up, right? We had you remember the dot-com boom and then the busts. But if you went the 10 years from 92 and you did the average annual return, you're getting about 8% from equities. Now, that's not bad. Now, we would take that today. Would looking out say would be a little bit more cautionary to think, Bill, you'd say 6 to 7% is what we'd expect from the market?
Last year they were up 12?
Yeah, I mean, the markets, this past 12 months have been, stronger, I think, than anybody anticipated. Again, to put it in a little bit of perspective, Tim said it right, you can't time this stuff. And so we think all the talk about what's going to happen the next quarter, what's going to even happen the next 12 months, to a large degree, it's all interesting and it's fun to do, and we all do it, but it's actually not that valuable in terms of being an investor. You really have to think in terms of longer time frames. And as Tim said, over the next decade, we expect returns might be a couple percentage points lower than the long-term averages. Based on where we are today, that's, we think, a pretty good bet, but that doesn't mean you shouldn't be in equities. The second thing I would point out is even when you are, looking at markets that are, sort of trending up over, 10 or 20 years, roughly a third of the time you spend in bear markets. So part of being an equity investor is learning to deal with that kind of volatility. And you will have fairly long periods of time where you're actually not doing well.
Right.
And again, historically it's been about 1/3 of the time. Actually, what's so interesting about where we are right now is, from 2009 to today, it's one of the longest bull markets in history. And we really haven't had much interruption, just a couple little blips, if you think about it. So we're actually kind of due for a prolonged, negative period at some point. And that's just going to be part of the process, if you will, to generate long-term returns.